And our final guest this evening is Gaius King, a resource analyst from Fox-Davies Capital. Tonight, Gaius addresses the uranium market, where market data shows that the output is only or just 72% of demand. Nuclear power is attractive because it's a green energy with baseload potential. Citi Bank say they expect uranium prices to average $110 a pound in 2025. Others expect prices to go as high as $150 a pound. Gaius King believes the data also shows there may be a short-term twist in that longer-term uranium bull market tail. Welcome, Gaius.
Thank you, Donald. Appreciate the opportunity. And hopefully you can see my screen.
We can see your screen. Thank you very much indeed for joining us tonight, Gaius. Do you want to deliver your presentation?
Absolutely. Thank you. Look, I apologise up front. This is going to be a very short, myopic view of the world. I'm primarily focusing on secondary shortages and why they're important, and not looking at demand at all, but hopefully it'll give a flavour of why I think uranium is a very exciting area to be in. What are critical commodities? Well, obviously uranium is one of them. And I know I've put this up before previously, but look, if it's not growing, it's mined. And mining may not be fashionable at the moment, and it's not ESG, but it is the basis of every modern economy. So if we look at the next page, figure 1, and as you can see with that graph, the uranium price has jumped 100% in the last 12 months, which is very good. If we turn the page again, Figure 2 shows that, but what we've plotted is the short-term price versus the long-term price. We would merely make the point that the short-term price, yes, that's jumped 100%, but the long-term price has only jumped 34%, and it sits 40% below the short-term price. The short-term price obviously is driven by more trading, and in particular, a certain Sprott uranium trust. But that's not to say that uranium is not in grand shortage, and we think it has a long way to run. Also, just to highlight what Donald just said there, even if we have a short-term uranium correction, and let's say that short-term price drops to where the long-term price is at the moment, do not abandon this sector because there are fundamental reasons why you want to stay in. So if we look at figure 3 at the next page, we've plotted here uranium, global consumption of uranium, and we make the point that it's been basically steady for 2 decades. That's despite Fukushima. And down the bottom there in red, that's the emergence of China and its nuclear industry. It's the second largest in the world now. If we turn the page again, please. And these are 2 graphs that just demonstrate that. So obviously the figure 4 shows the US, China, France, and Russia as being the top 4 nuclear countries. But figure 5 shows that France uses or generates 63% of its domestic electricity via nuclear power, and unsurprisingly has the cheapest power prices in the EU. If we turn the page and look at figure 6, and this is the crux of, I guess, this whole thesis of why uranium is very exciting. I was there in the original uranium boom in 05, 07, great times in Western Australia, great companies, very exciting. I think this uranium coming up is far more fundamentally based. And what we have here in the grey in the blue is consumption. What we have here in the grey is what we mine. And at the moment, we're only mining 72% of what we consume. The remaining 28% are coming from secondary resources. Why is that important? We turn the page to figure 7. In the past 2 decades, the uranium supply story is a Kazakhstan story. The Kazakhstan is that dark grey on top. It supplies about 40% of the world's uranium. Without Kazakhstan, global uranium consumption would have declined. I think Kazakhstan produced about 22,000 tonne per annum, and it peaked about 2016 at about 25,000 tonne. But without it, we would be far shorter in uranium than we otherwise would be. If we go to turn the page to figure 8, most of that's in situ leach. That's Kazakhstan and other places, and the rest is open pit. The largest resources in the world are Australia, but that's deceiving. Most of that can't be accessed. The largest second lot of resources in Kazakhstan, Canada, and Russia. If we turn the page, please, to figure 10 and 11. And this is how concentrated the industry is. 90% of global uranium production are from 10 companies. 2/3 of global uranium production are from Russia and its associates, whether that be Uzbekistan, Kazakhstan, Niger. And obviously, figure 11 just demonstrates where Kazakhstan really does play a major role, and then there's the rest. If we turn the page, please, to figure 12 and 13. So this talks about enrichment and primary conversion, let's say, into pellets to use into nuclear power plants. And yes, Russia plays a part, but there's also the UK and the US and whatever. But the point we would make is that it's pointless having conversion capacity if you don't own the primary production. And it's the argument we've used in other commodities with China, whether that be lithium or rare earths or whatever. China controls the primary supply and enrichment to that area, and they control the EV market. Well, we're saying the same is happening with Russia. So yes, enrichment capacity and fabrication does occur in other countries, but Russia controls the primary supply. Next page, please. And we'd also argue that actually mining cost is irrelevant. This is a cost curve, the most recent I got from Kazatomprom. It's a Kazakhstan producer. The vast majority of global uranium production is below $20 a pound. Now, the current price, spot price, is 100. So obviously, the price is not a large determined on supply coming online. You have to keep that in mind. That, and we'll return to it later, that uranium is geologically and geographically constrained. And it's the same with a lot of commodities. If you're looking for copper, you look in South America and maybe the Ring of Fire. Uranium only occurs in certain places. If we go to the next page, please. And this is the graph. So in figure 15, obviously you see Australia, there's a large amount of uranium. But the problem with the uranium in Australia is the vast majority of it, in fact, the vast majority of the world's reserves occur in one deposit. It's called Olympic Dam. 75% of its revenues are from copper, only 20% are from uranium. Any expansion going into Olympic Dam is unlikely to be done on the uranium price. So if you, and the other parts of Australia, there are great deposits in Western Australia and also in Queensland, but you can't mine those. The only places you can mine in Australia are the Northern Territory and South Australia. So Australia is sort of off limits, really. I mean, there's Boss Energy and a few others, but not great. So the two other big areas of interest you really want to look at is Canada and Kazakhstan. You can jump to the next slide, please. And this is also an important concept. It's probably intuitive, but I'll just highlight it because it's, I suppose, simple. When you're looking at coal-fired power or a gas turbine, the vast majority of the cost of generating the power of energy is from the commodity itself. In uranium, it's not, because there's a large amount of upfront capex. So at the end of the day, only 14% of the cost of power from a uranium plant is actually from the uranium price. So it's relatively inelastic, given that all the other cost inputs are relatively fixed. If we can go to figure 17. Now, Donald questioned why I kept this diagram in, but just basically to highlight the point that actually this industry is highly regulated, highly and vertically integrated. You can't break into it. You have to either be of two spheres, the Western or the Eastern sphere. Go to the next page, please. So, just to highlight a couple of points out of this diagram, peak mining for uranium occurred in 1980. From the start of uranium mining up to 1980, the vast majority of uranium went into bombs, after which it went into nuclear power stations. A lot of the bomb material that went from Russia, from the tons to megatons program, which is still ongoing, it's been extended 3 or 4 times, still occurs. If we go to the next page, please. Why is that important? Because we roughly know how much uranium has been mined historically, tonnage and grade and recoveries. That is the blue line. We also roughly know how much uranium we have used. So if we're saying we're only mining 72% of the uranium we're using and 28% of that is secondary supplies, the question then becomes how many or how much of secondary supplies do we have? And the gap between the blue and the red line is that, and that number is 525,000 tonne of uranium. Can we go to the next page, please? So a big warning on these numbers here. These are my numbers, they're not anyone else's, given I couldn't find anyone else's numbers pretty much anywhere else. So they are invariably wrong, but I had to give it a go. So I went around to different sources around the world, just tried finding where these inventories are, how much, and in particular Japan. Japan's been accumulating a lot of uranium. I think it's hidden at least 50,000 tonne. It's off the books, but, you know, we can't go there. I'm probably going to use it for something else. So if we go to the next page, please. Table 1. Okay, so these are the sources and where I got the tonnages from. And if we take it as gifted that there are 525,000, that's the maximum limit of secondary resources we have. We know that we consumed last year 19,000 tonne of uranium in secondary resources, and that gap is increasing every year. You just divide one into the other. Oh, and also what I did, I said, okay, let's say that we don't have the 100% of missing resources, that we have 80%. The numbers come up that suggest that we have somewhere between 11 and 6 years of secondary resources of uranium left. Sounds all right. Go to the next page, please. But, this is the big but. If you then say, okay, well, China and India control a substantial amount of those resources, and the US is quite well supplied with its own inventories, which you can look up and find out, it suggests that there's some Western European utilities have somewhere between 2 and 3 years of supply left, which is nothing, given that a nuclear power plant has to be refueled every 18 to 24 months. So these shortages that are coming are very real, and the impact could be literally catastrophic. Can we go to the next page, please? So this is just an example, Lazard's, I think it's 16th generation. Now the diagrams are quite common and they're quite complicated, and it's called a levelized cost of power. This is based in the US. And what this diagram is saying, if you look down to where nuclear is, sorry, it's a little bit fuzzy, I apologise for that, it suggests that the average cost for a nuclear power plant is somewhere between $140 and $220 per megawatt hour. And then if you look at wind onshore, it's half that, and solar is even less than that. And you think, well, why would anyone concentrate on old technology and build nuclear power when all these new generation renewable energies are just so much cheaper? And then I would draw you to one tiny little yellow dot on the nuclear thing that says $31. What does that yellow $31 mean? So if we go to the next page, please. And this is it. This is the cost of nuclear power in the US over the past 2 decades. In the last one I could find is 2021. It was $29 per megawatt hour. That's what it cost to generate in the US. Now, to give an example, in December last year, the average cost in the UK was $102 per megawatt hour. So what I'm saying is that actually the US nuclear power industry is producing power at 1/3 of the cost of what we're buying it for here in the UK. And if you're thinking you're going to run a modern economy economically against a multitude of manufacturing prowess out of China and services prowess coming out of India very, very soon, then you're behind the 8 ball if you can't afford to heat and warm buildings. Next page, please. So what we've done, and this is a work we've done behind the scenes, and I haven't bothered to put the data here because I just want to give you some of the results we've done. So what we did then is, okay, some of these costs look completely wacky. We will regenerate these costs, these levelized costs, because you don't know what assumptions they're using. I suspect I know what they've done, but I can't prove it. So Hinkley C is this nuclear power plant that's been built in the UK. It has the ignominy of being the most expensive, delayed, most contrived project in around. And then you have the Dogger Bank, which is the world's largest wind turbine. Now, they're both in the UK. They're both being built at the same time. Both have the same influences, labour costs, etc. Very good comparison. To cut a long story short, it appears that Hinkley C, the much derided Hinkley C, will produce power at half the cost of offshore wind turbines. That is not supposed to happen, but that is a fact. So what we did then, next page, sorry, what we did then is that we compared Hinkley C to a existing tracked solar battery, well, we added the battery component, a tracked plant out of northern Western Australia. And we put in a whole lot of unrealistic assumptions, including no transmission losses. We used 2 days in the middle of summer in February, January and February, and cloudless, and it could generate for 12 hours the track, the whatever. We used the battery cost from Vistra Moss, which is the world's largest battery project. They've just done a third grade upgrade, so we know those capex costs very well. They did an upgrade of Northern last year, so we know those capex costs, and we obviously know Hinkley C. So there's a whole lot of work behind this. But using a theoretical solar battery component and unrealistic operating parameters, Hinkley C would still be 20% cheaper. In reality, it's probably going to be 50% cheaper again. So if we go to the next page, please. We've also released some interesting research on EVs. And we'd make the point there's no such thing as an EV. There's maybe a solar powered car or a coal-fired power electric car or a gas-fired power electric car. Putting aside that some of the research out of Cornell is suggesting that actually natural gas produces more greenhouse gases than coal, we look primarily focused on electric vehicles generation out of China. If we can go to the next page, please. The results of this. A diesel Mini, 1.3 litre diesel Mini in the UK produces 60% less CO2 than an electric car out of China using a Leaf analogue. And even a petrol car out of in the UK produces about 30% less than an electric car out of China. In fact, if you look down the bottom of this table, it's 0.173. That's what we calculated electric car in China would generate. And if you look at a whole lot of other bunch of cars, these are official data from the UK. Actually, a lot of these vehicles in the UK don't produce that much more CO2 than an electric car out of China. So really, the generation component of the electric car is important. We go to the next page, please. And then we go to Volvo. Volvo, the first OEM that compared the same model of car that they generate, and they compared it with what it would take to break even with the CO2 contents. And they found that it takes roughly about 110,000 kilometres for an electric car to break even with a normal internal combustion engine. In the EU, if you did that same calculation, it's about 77,000 kilometres, because the EU has a lot more renewables and a lot more nuclear power. If you look at just run an electric car off a wind turbine, because electric cars require more graphite, nickel from Indonesia, rare earths, and a bunch of lithium, whatever, they require a lot more energy to create. So it takes a lot more CO2 to break even. Can we go to the next page, please? Sorry for rushing through this, but I was warned not to overrun. But we just reiterate, and we've shown this diagram before, there is no such thing as a low energy rich country. So pennies snitching everywhere and turning off lights and whatever does not boost the GDP growth of a country. You need to have cheap base load power that you can readily utilize, and that includes the UK. So we go to the next page, please. So what have we covered in this incredibly fast, brief summary? Uranium prices up 100% in the last 12 months, but it could suffer a short-term correction. Uranium demand has been incredibly stable. We have totally ignored, eschewed other analyst claims that uranium demand is actually going to increase dramatically. I would just say, where's that uranium coming from? At the moment, as of last year, our calculations are our calculations, not other people's. Our calculations suggest that only 72% of current demand is being supplied by primary, the rest is from secondary resources. The biggest swing producers, Kazakhstan, they can bring on ISL projects. I think in their IPO document, I can't remember exactly, they had about 50 deposits. ISL you can bring on fairly quickly, but they cut their production for some reason. So there's a lot of geopolitical playing going on there. Remind that uranium is geographically and geologically constrained. You can't find it everywhere. It's quite rare. And remind that the USSR did not have much uranium, and most of the Russian bombs actually came from East Germany, Saxony, and they mined them out. So all the Russian bombs that you see today are mostly German uranium. Secondary supplies are critical, and in fact, we would go as far to say that we think Sprott and Yellowcake will be nationalised. If you do that at current consumption levels, that gives us an extra 2.5 years. Go to the next page, please. We would suggest that a number of Western utilities only have 2 to 5 years of supply. The uranium industry is very vertically integrated. Some of the published costs on uranium are, I think, wrong, or at least we don't know what assumptions they're using. We think they're cheap. The IEA suggests that the average long-term cost for uranium is about $60 per megawatt hour. We think they're cheaper, 50% cheaper than wind turbines, offshore wind turbines, and at least 20% cheaper than solar battery combinations. Next page, please. So nuclear power is green. So fundamentally, from an analyst's point of view, what does that mean we should look at? Well, you need to look at existing resources near existing, I guess, infrastructure in places where they mine uranium. Australia, Namibia, Canada, and the US are obvious targets, given that's in our sphere of influence and investment. Kazakhstan and Uzbekistan are great places for uranium geologically, but maybe not necessarily investment-wise. And I would eschew larger, lower-grade deposits until the uranium price runs very hard. I think they would take longer to get in production. There's more risk associated with that. So you really want to target higher grade, lower capex, quick into production. And when you do all those overlays on top of each other and you rule out all different deposits and whatever in the world, and this is from a guy who was pushing uranium projects in Australia and in Africa in 05 to 07, I think this time around when the uranium boom is going to really kick off in a real way, it's going to be Canadian Athabasca Basin projects that you want to look at, and also other projects that geologists are pushing the envelope. Next page, please, which is the last page. I've had a look at a couple of good projects lately. Obviously, this is not an exhaustive list, and I apologise to any company that didn't quite make this list. There's just a few guys I pulled off the top of my head that are interesting. Most of them have Canadian focus. Yeah, that's it. Hopefully I kept it within my 20 minutes time frame. I'm not sure.
Okay, guys, don't worry about your time frame. Thank you very much. That was very interesting. Very thought-provoking as ever. So let me kick off with, you expect a short-term dip in the uranium price. So what's causing that short-term dip if demand is strong and output is weak?
Look, and I've just been, obviously I have a watch list of uranium companies. I'll just point out in the last 3 months, Cameco, despite a good production report, increased future production. I know they've forward sold a lot of their production going forward, etc. The last 3 months, price has gone down 20%. If you look at Denison, good story. Their share price has gone down 12% in the last 3 months. So the market is telling you that something is coming. Also, I would just point out that a lot of the, and it feels like a lot of the, sorry, can you see me, or am I supposed to just...
Yeah,
sure
you just get to answer my questions now, Gaius. I get to ask you questions now for the next 10 minutes.
Okay, apologise. Yeah, look, so in the back of my mind, I think the uranium price has been pushed up artificially because of Sprott's aggressive buying tactics. But it's not to take away that this is not a fundamental boom and it is going to go a lot higher. So I would expect if the spot prices, I think when I last looked at 102, I would expect it in the short to medium term to drop into the 70s, but then take off again.
Okay. Over the past year or two, we've been hearing from several TSX listed and NASDAQ listed operators, uranium operators, on our various webinars, and they've been taking their uranium leaching projects out of mothballs and quite quickly going into production again. So I was quite surprised that ISL leaching numbers are down. Is it a possibility of too much supply coming onto the market quickly?
Well, the shortfall at the moment is 19,000, I think, last year, and it'll probably be higher this year, 1,000 tonne of uranium. I mean, you have Boss Energy, which is a project, I think it was called Honeymoon Well about 10 or 15 years ago. I can't remember. That's coming into production now. You know, you have Peninsula Energy, I think, is in the US. That's interesting. I think they're swapping from an alcohol leach to an acid leach, so that should increase their recoveries massively. But they will barely touch that deficit, which is growing. Secondly, not only is the deficit growing, let's say if these other analysts, they're probably far more clever than I am, are correct in saying that there are all these other nuclear power plants coming online very quickly, and demand's going to grow. My argument would be, well, where is the uranium coming from? And I guess the big story then is Kazakhstan. What is Kazakhstan going to do? They say they have all these resources, but I know for a lot of their deposits, they haven't worked on them for over 10 years. So, and they're mining their best deposits now, and obviously the second generation deposits are going to be less attractive. So I think the world is going to have to rely on Kazakhstan a lot. There is not a lot other than Rossing South and a bunch of other associated deposits there. There hasn't been a lot of major discoveries made in uranium, and mind you, there hasn't been much uranium exploration done either. So no, I don't think it'll even touch the sides. We're talking minutiae amounts of tonnage coming online, and it will be more expensive and it will take far longer. And we're talking about here and now.
Okay, guys, you were very clear. You said secondary demand was the critical determinant. Can you explain a little bit more about what you meant by the critical determinant? Talk us through the secondary market.
Okay, so secondary supply. So secondary supply, when we talk about secondary supply, we're talking about bombs. So whether it be Russia taking whole bombs and doing from megatons to megawatts. The original deal, I think, went for about 10 years, and then it's been extended 2 or 3 times since. So at one stage, I'm not sure what the proportion is now, but at one stage, 10% of all the US electricity generation was primarily on Russian bombs. And the Russians obviously spent a lot of money mining that decades and decades ago, and obviously it's very enriched, so they have to de-enrich it. It was a good program. I think less nuclear weapons is always a good idea. So that's one source. You have then companies like Sprott and Yellowcake who are taking Yellowcake and storing it. That's just another secondary resource. And also you have secondary processing. So obviously when you run fuel through a plant, it denigrates from 238 to 235 and other daughter products. I think there are 32 daughter products in uranium. And then you can reprocess it, make pellets again and rerun it. So secondary resources are anything other than primary mining, but they're very limited.
Okay, and I suspect a question that we're all thinking, to what extent does Western energy security become a factor with nuclear processing and mining, given that Kazakhstan, as you say, is a swing producer?
Well, that's the interesting thing. And look, this is a question we started asking in the middle of last year. If what we think there is going to be another uranium boom, where do you want to go and what companies do you want to buy? And so you start overlaying different investment narratives and fields. And the idea actually, my experience, several decades of experience, is telling me it's not necessarily telling you what companies to buy. It tells you what companies not to buy. And so it sort of came to me that really, given the extreme negativism towards the nuclear industry in general, you want to go to a place where you can actually mine it. They're usually high grade, small, high cash flows, existing infrastructure, so you don't have to worry about processing plants and the whole works. I mean, there are 2 processing plants in the Athabasca Basin that you can toll treat through. So it just occurred to me that that's probably the best area. And then I started looking at the companies in that region. There's some really good companies. I mean, Ather Energy Corp, which I'd never heard of before, the guys there spent 10 years acquiring a massive land package that no one wanted. No one wanted to know the uranium, and then came to market. I mean, that's what you want to find. You want to find these guys who are experts in the area. Or I can't remember. There was I think it was Forum Energy. I think it was Rebecca. She worked for Cameco, and then she did a PhD. Obviously, lost her job, did a PhD. She's got a theory about another basin, and there's actually another deposit along the line, and that's where mining is almost like biotech. Mining is very much a scientific endeavor. You go out with a specific geological model, you test that geological model, it's a fail or prove, or you adjust, and then you go out again. So there is opportunity, I think, and on personal, look, there's something else about mining.
I'm going to jump in, ask you my final question.
Final question.
So, if nuclear power is as cost effective as your analysis indicates, why doesn't Britain develop more nuclear power? There's a straight question for you.
And it's not so straight. So I was writing about this when I was working for a different shop. I was writing about this 15 years ago. And I was predicting, typical analyst, waving my hand saying, look, the UK is going to hit a cliff, an energy cliff. But what I didn't see then was the rise of renewables. So actually wind turbines and some solar and additional gas has really pushed that cliff out for the UK a long, long way, probably a decade longer than I was expecting. But that cliff will arrive. And those renewables and all the promises and the costs associated with those renewables are not going to come true. They are a lot more expensive. The battery technology doesn't exist. It's not cost effective. It burns. Alta Vista had 3 fires last year. So nuclear power is needed, but there is just so much angst against it. And hence the reason why they're pushing these SMRs, small modular reactors. That's just an excuse not to invest into existing nuclear technology. And I've written on that recently too, but yeah.
You're not a fan of SMRs, Gaius?
I think no, look, there are needs for it, but as far as I'm aware, there's only 2 SMRs globally. There's one in China that was experimental, and then the Russians. The Russians are a long way ahead. And SMRs are effectively a nuclear module, a bit like there's 160 ships floating around on Earth with nuclear reactors, most of them submarines, 200-odd reactors. Some of the big aircraft carriers have 2. They're very expensive, and they have to be incredibly well monitored. They have to have very specially trained people. So when people say, oh, we'll just build an SMR and we can put it all over the UK and whatever, no, you won't be able to, because the same legislative framework, and this is what we went into in a great way, the same legislative framework that you do for a conventional nuclear plant, you have to do for an SMR. And then it comes out in the US, some of the preliminary costs. SMRs are not even that cheap. So what we're saying is that a conventional nuclear power plant is 50% cheaper than an offshore wind turbine, but an SMR is only 20% cheaper than an offshore wind turbine. They're substantially more expensive. So we think now that SMRs will be used in conjunction with existing area sites of nuclear power plants, which makes sense because you have approvals and whatever, and it'll be done very, very quickly. But SMRs, I think, is a little bit more hype than fact.
Okay, brilliant. Gaius King, you're a star. Thank you very much indeed for joining us tonight, Gaius. That's Gaius King, a resource analyst from Fox-Davies Capital.